Hey there everybody, Andrew Marlow here with Marlow's Mortgage Minute, bringing you all the tips and tricks in the mortgage world. Today we're going to be talking about something that is pretty popular right now because a lot of people have very, very low first mortgages and the first mortgage rates, and they don't want to do a cash out refinance, but they might want to access some of the equity in their home. So we have a couple of different ways that you can do that. The most common ways to do that without touching the first mortgage is by doing either a HELOC or a HELOAN. HELOC is a home equity line of credit. A HELOAN is a home equity loan. We're going to talk about which one makes more sense in what scenario and when they have their purpose for each. So without any further ado, dive right in. First, let's talk about HELOCs. HELOCs are a flexible way to access your home's equity. One of the major benefits of a HELOC is its flexibility. You can take out a HELOC of $100,000, but only draw out of that $100,000 $25 if you want to. So you still have access to that $75, but you're only paying a mortgage monthly payment on the $25. You can kind of take it as you need it and pay it back and take it all within the draw period. There's usually a 10-year draw period where you can do this. You can take out money, you can pay it back, you can take it out again, and you have it always there, line of credit to use if you need it. It's great for people that need that flexibility, people that don't need a certain amount at one time. It's just, hey, I want to have access to my equity and use it as I need it, and I'll repay it and pay it back anytime I need to. And the other cool thing about it is during the draw period, it's interest-only payments for the minimum payment. If you take out $25,000 and you don't care about paying it back to take it out again, you make interest-only payments and you keep your costs low, and then you can pay it back as you need to or as you need to get more equity out of your home. Besides that, the negatives of a HELOC is 99% of them, probably 100% of them are adjustable rate mortgages. So those are the pros of a HELOC, but there are a couple cons of it. One of the major cons is the interest rate is not fixed. It's a variable interest rate, and it's kind of tied to a specific market. Usually it's either the federal funds rate or any kind of market out there that can be indexed. It's tied to that. And then there's a real risk of overspending. So let's say you get a line of 100,000 like we were talking about earlier, and you run it all up and you have a whole 100,000 out. That's going to be an expensive monthly payment, and you don't have any more equity you can pull out. So it's kind of risky in that sense. But for the most part, they're great loans. They're great for people that need that flexibility and have that access to the equity. And I mean, they're wonderful in that sense. So that's really it for HELOCs. Next, we're going to kind of dive into a HELOAN. So a HELOAN works a little bit differently than a HELOC. You're still accessing your equity. You're still not touching that first mortgage, but a HELOAN is a fixed rate mortgage with a fixed dollar amount. So like on the HELOC, you could get a line for 100, only take out 25, whatever. On a HELOAN, if you're asking for 100, you're going to get 100. You're paying a fixed payment on $100,000 over the next 15 to 30 years. And it's a set cost that you know what it's going to be every month. Now, these are really great for people that have, let's say, a home construction project. They don't need access to the equity ongoing. It's just a one-time thing. They want to take $50,000 out to fix their bathroom or upgrade their home. You do that through a HELOAN. You don't touch the first mortgage. You have the second mortgage, which is also a fixed loan. And eventually, once rates drop, you refi both of them to combine them into one, and you have a lower monthly payment overall. Or HELOANs are really great in that sense, where they're a fixed rate and you know what you're going to be paying and it's all set, and it really offers that stability that a HELOC does not offer. Besides that, on a HELOAN, the initial closing costs are typically a little bit higher compared to a HELOC, but it's pretty comparable between banks and between loan products. And it's also a great tool to have. So it's really good to know the pros and cons of both of them. So if you have a situation where you're thinking about you want to access the equity in your home, but you don't want to touch that first mortgage that's at a 2.5% rate, I don't either. So this gives you an option to pull out equity from the home without having to sell, without having to do anything else. You can consolidate your debt, you can pay off your credit cards, you can take out money for school, you can do whatever you really need to with it, and you can have that peace of mind that you don't have to pay more on your entire mortgage. And it's just a little piece that you need the money for. So that's really a quick video about the pros and cons of a HELOAN versus a HELOC. If you have any questions or if you want to talk about it further, talk about anything further, please feel free to reach out to me anytime. If you found some value in this video, please like, share, subscribe, send it to all your friends, send it to their friends, and I hope you guys have a wonderful day. Thank you. Stay safe.